Before we begin, please remember that I am not a licensed financial advisor, mortgage broker, or real estate professional. This presentation is for informational and educational purposes only and should not be considered financial, legal, or tax advice. The world of real estate and finance is complex and constantly changing. Always consult with a qualified professional before making any major financial decisions. I'll never forget the feeling, sitting in a sterile windowless office, staring at a stack of paper that looked thicker than my college textbooks. The closing agent, a perfectly nice person, was speaking a language I didn't understand. Here's your truth in lending statement. Initial your amortization schedule, and this is the deed of trust. My hand was cramping, my head was spinning, and a wave of cold panic washed over me. I was about to sign my name to the single largest debt I would ever have in my entire life, a 30-year commitment, and I honestly couldn't explain what half of these documents meant. I was just trusting that it was all standard, trusting that no one was taking advantage of my ignorance. I felt completely powerless, and right there, pen in hand, I made a promise to myself. I would master this, and then I would make sure no one else ever had to feel that way again. That's why we're here today. This isn't just another boring video defining a financial term. This is your training manual. This is your guide to taking back control. Over the next several parts, we are going to pull back the curtain on the entire mortgage industry. We will decode the jargon, demystify the numbers, and arm you with the knowledge you need to walk into that closing office not with fear, but with total and complete confidence. By the end of this, you won't just know what a mortgage is, you'll understand how to make it work for you, not the other way around. You'll be able to spot red flags, ask the right questions, and negotiate from a position of strength. The American dream isn't just about owning a home, it's about owning it on your terms. So let's start at the very beginning. What exactly is a mortgage? Forget the fancy bank terminology for a second. At its absolute core, a mortgage is just a loan. That's it. It's a very big, very serious, very long-term loan that you get from a lender like a bank or a credit union for the specific purpose of buying property. Think of it like this. You want to buy a $400,000 house, but like 99% of the population, you don't have $400,000 in cash just sitting in your checking account. So you go to a lender and you say, "Hey, I'd like to buy this house. Can you lend me the money?" The lender says, "Sure, but this is a huge amount of money, so we need a guarantee that you'll pay us back. So we'll give you the loan, but we're going to use the house itself as collateral." And that right there is the magic key. The collateral. The word mortgage literally comes from Old French, and it means death pledge. A little dramatic, I know, but it gets the point across. It's a pledge that you will pay back this debt until it's dead. And if you fail to do so, the lender has the legal right to take the property from you. That process is called foreclosure. We'll talk more about that later, but for now, just understand the simple exchange. The lender gives you a massive pile of cash, and in return you give them a legal claim to your house until the debt is paid in full. This whole transaction really revolves around three key players. Think of it as a three-legged stool. If any one of these legs is weak, the whole thing falls over. First, there's you, the borrower. You're the one who wants the house and needs the money. You are making the promise to pay it back month after month, year after year. Second, there's the lender. This is the financial institution, the bank, the credit union, the mortgage company that has the capital to lend. Their job is to assess your risk, decide if you're a good bet, and if so, give you the funds. They make their money by charging you interest, which is essentially the fee you pay for the privilege of using their money. And third, there's the property itself. The house, the condo, the piece of land. This is the asset. It's the reason for the loan, and it's the lender's security blanket. The property has to have value, usually determined by an appraisal, to justify the size of the loan. The lender won't give you $400,000 for a house that's only worth $200,000, because if you stop paying, they'd lose a fortune. So you, the lender, and the property, these three elements form the foundation of every single mortgage deal in the United States. Now that we know the what and the who, let's talk about the how. How is that monthly payment you'll be sending for the next 30 years actually calculated? Most people think they're just paying back the loan, but it's a little more complicated than that. Your monthly mortgage payment is almost always made up of 4 distinct parts. And you need to remember this acronym for the rest of your home buying journey: PITI. That's PITI. It stands for principal, interest, taxes, and insurance. Let's break them down one by one. First up, P is for principal. This is the easy one. The principal is the original amount of money you borrowed. If you get a loan for $300,000 to buy a house, your starting principal is $300,000. Every time you make a payment, a portion of that payment goes toward chipping away at this principal balance. It's the part of your payment that actually builds your ownership, your equity in the home. Next, I is for interest. This is the big one. This is the lender's profit. Interest is the fee you pay the bank for lending you all that money. It's expressed as a percentage, your interest rate. A lower interest rate means you pay less for the loan over its lifetime. A higher rate means you pay more. And believe me, a single percentage point can mean the difference of tens, or even hundreds of thousands of dollars over 30 years. Here's the critical thing to understand about the relationship between principal and interest. In the beginning of your loan, the vast majority of your monthly payment goes toward paying interest. A tiny little sliver goes to paying down your principal. It's a shocking realization for most new homeowners. You might make payments for 5 straight years, and you'll look at your statement and see that your $300,000 loan balance has only gone down to maybe $280,000. Feels like you're running in place. This is by design. It's called an amortization schedule. The bank gets its profit up front. Then, as the years go by, the scale slowly tips. Less of your payment goes to interest and more goes to principal until in the final years of the loan, almost your entire payment is going toward that principal balance. Okay, so that's the P and the I, the core of the loan itself. But we're not done. Next in PITI is T4 taxes. Property taxes. When you own a home, you have to pay taxes to your local government, your city, your county, your school district. This money funds public services like schools, police, firefighters, and road maintenance. The amount you pay is based on the assessed value of your property and the local tax rate. It has nothing to do with your lender, but often, the lender will collect it from you as part of your monthly mortgage payment. Why? Because the government's claim on your property for unpaid taxes is actually stronger than the bank's claim. The bank wants to make absolutely sure those taxes get paid, so they often take care of it for you. Finally, we have the second I in PITI, which stands for insurance. Specifically, homeowners insurance. Lenders will not give you a loan for hundreds of thousands of dollars without proof that you have an insurance policy to protect their investment. If your house burns down in a fire and you don't have insurance, you can't pay for repairs, you might walk away from the loan, and the bank is left with a worthless, charred pile of rubble. Homeowners insurance protects against disasters like fire, theft, or storms. Just like with taxes, you pay a monthly premium for this insurance, and the lender will typically collect it as part of your total payment. So, they take the portion for taxes and the portion for insurance and put them into a special savings account called an escrow account. Then, when the tax bill and the insurance bill are due each year, the lender pays them on your behalf out of that account. This ensures those critical bills are never missed. So there you have it. Principal, interest, taxes, and insurance. PITI. When you hear a lender quote you a monthly payment, you have to ask, is that the PITI payment? Or is that just principal and interest? It's a rookie mistake to only budget for principal and interest, because taxes and insurance can add hundreds, sometimes even thousands, of dollars to your monthly bill. This is the bedrock. Understanding this structure, the loan as a pledge, the 3 key players, and the 4 parts of your payment, is the first most crucial step toward becoming an empowered homebuyer. You've now learned the basic anatomy of a mortgage. But this is just the beginning. We've talked about what interest is, but we haven't talked about the most important part, how you can get the lowest rate possible and how the banks decide what you deserve. So let's pull back the curtain on that secret meeting, the one where a group of people you've never met decide the interest rate you'll be paying for the next 30 years. It feels like a mystery, right? Like they're reading tea leaves or consulting a crystal ball. But it's not magic. It's a calculation. It's a cold, hard assessment of one single thing: risk. To a lender, you are not a person with dreams of a white picket fence. You are a risk profile, and their entire job is to figure out exactly how risky you are. The higher the risk they think you are, the more they charge you for the privilege of borrowing their money. That extra charge is your interest rate. The lower your risk, the less they charge you. It's that simple. So, the billion-dollar question is, how do they measure that risk? They look at your financial life like it's a resume for the most important job you'll ever apply for: the job of being a reliable borrower. And there are 4 main sections on that resume they are going to scrutinize under a microscope. First, and by far the most important, is your credit score. This is the headline on your resume. It's the first thing they see, and it instantly frames their entire perception of you. Think of your credit score as your financial trust score. It's a single number, usually between 300 and 850, that summarizes your entire history of borrowing and repaying money. Have you paid your credit cards on time? Have you defaulted on a car loan? Do you carry a massive amount of debt? It's all baked into that one powerful number. Imagine you have two friends. Friend A always pays you back the $20 you lend them, usually a day early. Friend B always forgets, and you have to awkwardly remind them for weeks. If both asked to borrow $1,000, who would you feel more comfortable lending to? And if you did lend to friend B, wouldn't you want a little something extra for the stress and the risk? That's exactly how a bank sees your credit score. A high score, say 760 or above, tells the bank you are friend A. You are reliable. You are a low risk, and they will fight over you, offering you their very best interest rates. A lower score, let's say under 640, tells them you might be friend B. You have a history of being late or missing payments. You're a higher risk. They'll still lend you money, but they're going to charge you a premium for it. A significantly higher interest rate. The difference between a 760 score and a 640 score on a $300,000 mortgage can mean paying over $100,000 more in interest over the life of the loan. $100,000. All because of that one number. The second section of your financial resume is your debt-to-income ratio, or DTI. If your credit score is about your past, your DTI is about your present. It's a snapshot of your current financial stress level. Lenders calculate it very simply. They add up all of your monthly debt payments, student loans, car payments, credit card minimums, and they divide it by your gross monthly income, which is how much you make before taxes. Let's say you make $5,000 a month, and let's say your car payment is $500, your student loans are $300, and your credit card payments are $200. Your total monthly debt is $1,000. 1,000 divided by 5,000 is 0.2, or 20%. Your DTI is 20%. Why does the bank care so much about this? Because it tells them how much breathing room you have in your budget. If your DTI is low, like 20%, it shows them that a large portion of your income is free and clear. You can easily handle another payment like a mortgage without being stretched to the breaking point. But if your DTI is high, say 45% or 50%, it sends up a huge red flag. It tells the lender that nearly half of your income is already spoken for before you even pay for groceries, gas, or utilities. Adding a hefty mortgage payment on top of that is a recipe for disaster. It means one unexpected car repair or medical bill could cause you to miss a payment. You become a much higher risk. Most lenders have a hard cutoff, often around 43%, but the lower your DTI, the more attractive you are, and the better the rate you're likely to get. The third section on your resume is your down payment. This is your skin in the game. It's the amount of your own cash you're putting into the deal up front. For decades, the golden rule was that you needed 20% down to buy a house. If the house was $400,000, you needed $80,000 in cash. Now, that is still the gold standard, but it's no longer a strict requirement. There are many loan programs today that allow you to put down as little as 3% or even 0% in some cases. But make no mistake, the size of your down payment has a massive impact on how the lender views you. Putting down 20% or more does two magical things. First, it instantly makes you a lower risk. Why? Because you have significant equity in the home from day one. You are far less likely to just walk away from the loan and let the bank foreclose if it means losing your $80,000 investment. A person who puts down only 3% or $12,000 has far less to lose. They are, in the bank's eyes, a greater flight risk. Second, putting down 20% allows you to avoid something called private mortgage insurance, or PMI. PMI is an extra insurance policy that you, the borrower, have to pay for, but it protects the lender in case you default. It can add hundreds of dollars to your monthly payment without a single cent going towards paying off your actual loan. By putting down 20%, you eliminate this extra cost entirely, and the bank sees you as a more financially stable, less risky applicant, rewarding you with a better interest rate. The fourth and final piece of the puzzle is the loan itself, the type of loan and the term you choose. A 30-year fixed-rate mortgage is the most common in the United States, but it's not the only option. You can also get a 15-year loan. Think about it from the bank's perspective. Lending someone money for 30 years is inherently riskier than lending it for 15. A lot can happen in 30 years. People change jobs, economies crash, things change. A 15-year timeline is much more predictable. Because of this reduced risk, lenders almost always offer a lower interest rate on a 15-year mortgage than on a 30-year one. The monthly payment will be higher, of course, but the total amount of interest you pay over the life of the loan will be drastically lower. So there you have it. Your credit score, your debt-to-income ratio, your down payment, and your loan choice. These are the levers you can control. They are the sections of your financial resume that you can polish and perfect to present yourself as the safest, most reliable bet a lender could possibly make. But there is one more massive factor that influences your interest rate, and it's one that you have absolutely zero control over. The economy. The overall health of the U.S. economy and the decisions made by the Federal Reserve set the baseline for all interest rates. When the Fed raises rates to fight inflation, mortgage rates go up for everyone, regardless of how perfect their financial resume is. When they lower rates to stimulate the economy, everyone's rates tend to go down. It's the tide that raises or lowers all ships. You can't control the tide, but you can build the best, most seaworthy ship possible. By focusing on what you can control, by building an excellent credit score, keeping your debt low, and saving for a strong down payment, you ensure that no matter what the market is doing, you will always be offered the absolute best rate available at that time. You put the power back in your hands. We've just demystified the bank's decision-making process. You now know exactly what they're looking for. But knowing is only half the battle. The other half is doing. So where do you start? You start with the single most important factor, your credit score. And in the next part, we are going to break down exactly step by step how to build and protect that number, and a few little known tricks you can use to give it a significant boost in a surprisingly short amount of time. So let's talk about that number. That 3-digit score that can feel like a mysterious grade handed down from on high. A number that has the power to either open the door to your dream home or slam it shut in your face. We're talking, of course, about your credit score. And I want to be crystal clear. This isn't just about getting approved for a mortgage. This is about saving you tens of thousands, or even hundreds of thousands of dollars over the life of your loan. Think of it like this. 2 people walk into a bank to get a mortgage for the exact same $400,000 house. Person A has a credit score of 760. Person B has a score of 640. The bank sees Person A as a very reliable, low-risk borrower. They're a sure thing. They get offered a great interest rate, let's say 6%. Person B with the 640 score is seen as a higher risk. The bank is more nervous about lending them money. So to compensate for that risk, they offer them a higher interest rate, maybe 7.5%. Now, 1.5% doesn't sound like a huge difference, right? Wrong. On that $400,000 loan, that small difference costs Person B an extra $560 every single month. Over 30 years, Person B will pay over $200,000 more in interest than Person A for the exact same house. That's the price of a second house in some parts of the country. That's the power of your credit score. It's not just a number. It's a direct reflection of how much your financial future is going to cost you. So, how is this all-powerful number calculated? Who decides if you're a 640 or a 760? While the exact formula is a secret recipe like the one for Coca-Cola, the main credit scoring models like FICO are very open about the ingredients. There are 5 key factors, and understanding them is like being given the answer key to the most important financial test of your life. The first, and by far the most important ingredient, is your payment history. This makes up a whopping 35% of your score. It's the king. It answers the most fundamental question a lender has. Do you pay your bills on time? That's it. It's that simple. One late payment, especially a recent one, can be like a wrecking ball to your score. A 30-day late payment can drop an excellent score by 60 to 110 points. That's devastating. The single most important thing you can do for your credit is to pay every single bill on time, every single time. No exceptions. The best way to guarantee this? Put everything you possibly can on autopay. Your credit cards, your car loan, your student loans. Set it and forget it. Automate your success so you never have to think about it again. The second most important ingredient, making up 30% of your score, is called amounts owed, but a better way to think of it is your credit utilization ratio. If payment history is the king, this is the queen. This metric looks at how much of your available credit you're actually using. Let's say you have one credit card with a $10,000 limit. If you have a $2,000 balance on it, your utilization is 20%. You're using $2,000 of your available $10,000. Now, you've probably heard the rule of thumb to keep your utilization below 30%. And that's not bad advice. But if you want to supercharge your score for a mortgage, 30% is not the goal. The goal is under 10%. People with the absolute best credit scores, we're talking 800 and above, typically have a utilization ratio of less than 7%. Lenders see low utilization as a sign that you aren't overextended and you don't live paycheck to paycheck, relying on credit to get by. And this is where we get to our first little-known trick to give your score a major boost fast. Most people think their credit card company reports their balance to the credit bureaus on the day their payment is due. That's not true. They almost always report the balance that's on your statement when it closes. This is a game-changing piece of information. It means you could be using your card all month, paying it off in full by the due date, and still have a high utilization ratio reported. Here's the trick. Find out your statement closing date for each of your credit cards. You can find it on your statement or by calling the company. Then, a few days before that date, make a payment to bring your balance down as low as possible, ideally to just a few dollars. That way, when the card company reports to the bureaus, it reports a tiny balance, and your utilization plummets. Your score can jump 20, 30, even 50 points in a single month just by doing this without changing your spending habits at all. Another quick way to improve this ratio? Call your credit card companies and ask for a credit limit increase. If they raise your limit from $10,000 to $15,000, that $2,000 balance suddenly goes from 20% utilization down to just 13%, instantly boosting your score without you paying off a single penny. Okay, let's move on. The third factor, making up 15% of your score, is the length of your credit history. This is about your age. Your financial age, that is. Lenders like to see a long, established history of you responsibly managing credit. This is why you should never ever close your oldest credit card account. Even if you don't use it anymore, even if it has a small limit and no rewards, that card is the anchor of your credit age. Closing it can shorten your credit history overnight and cause your score to drop. If you don't use it, just put a small recurring charge on it like a Netflix subscription, set it to autopay, and stick the card in a sock drawer. Keep it open forever. The fourth factor is your credit mix, and it accounts for 10% of your score. Lenders like to see that you can successfully manage different types of credit. There are two main types: revolving credit, like credit cards, and installment loans, which have a fixed payment for a set period, like a car loan, a student loan, or a mortgage. Having a healthy mix of both shows you're a versatile and reliable borrower. Now, this isn't something to force. You should never take out a loan you don't need just to improve your credit mix. This factor tends to take care of itself over time as you go through life. Finally, the fifth factor, also making up 10% of your score, is new credit. This looks at how recently and how often you've applied for new credit. When you apply for a loan or a credit card, it usually results in a hard inquiry on your report, which can temporarily ding your score by a few points. One or two inquiries here and there isn't a big deal. But if a lender sees a whole bunch of recent inquiries, it's a red flag. It makes you look desperate for credit, like you're in financial trouble. So, in the 6 months to a year leading up to your mortgage application, you need to go on a credit lockdown. No new car loans, no new credit cards, no financing a new sofa. Just let your credit report hibernate and look as stable and boring as possible. So to recap, pay your bills on time always. Keep your credit card balances incredibly low, especially on your statement closing date. Keep your oldest accounts open. And don't apply for a bunch of new credit before you apply for a mortgage. Your credit score is not a reflection of your worth as a person. It's a game. And what we just did is walk through the rulebook. Now you know how to play. You have the power to build, protect, and rapidly improve that number. It's one of the most controllable pieces of the entire mortgage puzzle. Now that we've covered your income, your debts, and your credit score, the 3 pillars of your financial profile, it's time to start gathering your ammunition. I'm talking about the actual physical proof of everything we've just discussed. The paperwork, the documentation, the mountain of files that you'll need to hand over to a lender to prove you are who you say you are. And in the next part, we're going to build your mortgage application binder together piece by piece, so you can walk into that process with the confidence of a pro, armed with every single document you'll need before they even ask for it. Alright, let's build this thing. Think of it not as a pile of paperwork, but as your financial life story, bound in a single volume. This binder is your autobiography, and the loan underwriter is the most critical book reviewer you'll ever meet. They're going to read it cover to cover to answer one fundamental question. Are you a reliable protagonist for a 30-year-long story? So, what are the chapters in this story? We can break them down into 4 main sections: your income, your assets, your debts, and your identity. First up, Chapter 1, the story of your income. This is the engine of your financial life. The lender doesn't just want to know what you make. They want to know that you make it consistently and reliably. They're looking for stability. So the first documents you'll slide into those plastic sleeves are your most recent pay stubs, typically covering the last 30 days. Think of these as the latest snapshots of your earning power. They show your gross pay, your net pay, your year-to-date earnings, and any deductions. It's the real-time proof of your current financial pulse. But snapshots are just one moment in time. The lender needs the family photo albums. That's where your W-2 forms come in. You'll need the last 2 years of W-2s from every employer you've had. These documents are the official, IRS-stamped summary of your annual earnings. 2 years of W-2s don't just show what you make now, they show a pattern. They tell the lender, look, this person has a history of consistent employment and income. It builds a narrative of reliability. And to complete the trilogy of income proof, you'll need your federal tax returns for the past 2 years. All pages, and I mean all of them. The tax returns are the director's cut of your financial movie. They confirm what your W-2s say, but they also reveal other potential income sources, or losses, that might not show up anywhere else. Now, for all my self-employed people, my freelancers, my gig economy hustlers, your chapter on income is going to be a bit thicker, and that's okay. Your story is one of entrepreneurship, and you just need a few extra documents to tell it. Instead of W-2s, your key documents will be your 1099 forms from the last 2 years. But more importantly, you will absolutely need those 2 most recent years of complete personal and business tax returns. The lender is going to look at the net income, not the gross. This is a critical pro tip. The same income you report to the IRS to pay less in taxes is the same income the bank will use to qualify you for a loan. You can't have it both ways. So you'll also likely need a year-to-date profit and loss statement, or P&L, for your business, and sometimes even a letter from your CPA confirming your business is still active and thriving. For you, the story isn't just about income. It's about the stability and viability of your business. Okay, deep breath. That's the first and biggest chapter. Chapter 2. The tale of your assets. This isn't about what you earn. It's about what you have. This is the proof that you have the cash for your down payment, your closing costs, and some reserves left over for a rainy day. The primary documents here are your bank statements. You'll need the last 2 months of statements for every single account you have. Checking, savings, money market accounts, you name it. And here is a non-negotiable rule. You need every single page of the statement. Yes, even page 8 of 8 that's completely blank or just has fine print. Why? Because the lender needs to verify that the document hasn't been altered. A missing page is a red flag. Now, while the lender is reading your bank statements, they're looking for something very specific. Large, unusual deposits. A $50,000 deposit that suddenly appears out of nowhere a month before you apply for a mortgage is the biggest plot twist an underwriter can find. They're going to ask, where did this come from? Because if it's a loan from a friend that you have to pay back, that's an undisclosed debt, and that changes everything. If that money was a gift from a family member, that's perfectly fine. But you need to document it. You'll need what's called a gift letter. A simple signed letter from the person who gave you the money, stating that the funds are a gift and there is no expectation of repayment. You'll also need proof of the transfer, like a copy of the check or the wire confirmation. You have to be able to source and explain every dollar that will be used for the transaction. This isn't about being nosy. It's about complying with federal anti-money laundering laws and ensuring you can truly afford the home. Your assets chapter also includes any investment or retirement accounts, like your 401k or stock brokerage accounts. You'll need the last 2 monthly or most recent quarterly statements for these as well. This shows the lender you have reserves, a financial cushion, which makes you a much less risky borrower. Next, Chapter 3. The history of your debts. Every good story has conflict, and in your financial story, your debts represent the obstacles your income has to overcome each month. The lender needs to see a full, transparent picture of your liabilities to calculate your all-important debt-to-income ratio. This means you'll need recent statements for any outstanding loans. Think car loans, student loans, or any personal loans. The statements show your current balance and, most importantly, your required minimum monthly payment. You'll also need a clear picture of your credit card debt. While the lender will see this on your credit report, having the statements handy can sometimes help clarify things. Most importantly, you need to be prepared to explain any major red flags, like collections or recent late payments that might show up. Honesty and documentation are your best friends here. This chapter also includes obligations that might not be on your credit report. Are you paying alimony or child support? You'll need to provide the official divorce decree or court order that outlines those payments. Again, it's all about creating a complete and honest picture of your monthly financial obligations. The lender is simply adding up all these monthly payments and comparing them to your monthly income. They want to make sure there's enough money left over to comfortably afford the new mortgage payment plus, things like food and electricity. Finally, we arrive at the last and simplest chapter. Chapter 4. The saga of your identity. After all this financial documentation, the lender needs to know that you are who you say you are. This part is easy. You'll need a clear, unexpired copy of your government-issued photo ID, like your driver's license or a passport. You'll also need a copy of your social security card, or proof of your tax identification number. This is the official seal on your story, the author's signature that ties everything together. And that's it. That's your binder. Income, assets, debts, identity. When you gather all of this ahead of time, you're not just being organized. You're transforming the entire mortgage process. You're changing it from a stressful, reactive scramble into a calm, proactive presentation of your financial story. You are in control. You've built your binder. You've told the story of your income, your assets, and your debts. But there's one character in this story we haven't talked about yet. A single 3-digit number that can either be the hero or the villain of your home buying journey. It's the number that influences your interest rate, your loan approval, and ultimately how much money you'll pay over the next 30 years. It's your credit score. And in the next part, we're going to demystify that number completely so you can turn it into your greatest superpower. So, what is this 3-digit number that holds so much power? Think of your credit score as your financial GPA. It's a grade from 300 to 850 that tells lenders one simple thing. How likely are you to pay back borrowed money on time? It's a measure of your trustworthiness, a snapshot of your financial reliability. When a bank is about to lend you hundreds of thousands of dollars, you better believe they want to see your report card first. Now, you might hear a few different names thrown around like FICO and VantageScore. While they're slightly different models, they're built on the same core principles. For mortgages, the FICO score is king. It's the one that nearly every lender in the United States will pull. And that FICO score isn't just one random number. It's a carefully calculated result based on 5 key ingredients. Understanding these 5 ingredients is the secret to unlocking a great score. It's how you take control. The first and most important ingredient, making up a massive 35% of your score, is your payment history. This is the big one. It's the foundation of everything. Do you pay your bills on time? All of them? Your car payment, your student loans, your credit cards, even that small medical bill you forgot about? Every late payment is a crack in that foundation. A payment that's 30, 60, or 90 days late is a significant red flag to a lender. And more serious events, like collections, foreclosures, or bankruptcies, can be devastating. The message here is simple but non-negotiable. Pay every single bill on time, every single time. Set up automatic payments. Put reminders in your calendar. Do whatever it takes because nothing impacts your score more than this. Next up, accounting for 30% of your score is amounts owed. This sounds straightforward, but it has a crucial nuance. It's not just about how much debt you have. It's about how much debt you have compared to your total available credit. This is called your credit utilization ratio, and it's a game changer. Let's say you have one credit card with a $10,000 limit. If you have a balance of $5,000 on it, your utilization is 50%. That's high. Lenders see that and get nervous. It looks like you're stretched thin, relying heavily on credit to get by. But if you have that same $10,000 limit and only a $1,000 balance, your utilization is just 10%. You look like a responsible borrower who uses credit wisely without depending on it. The golden rule? Keep your overall credit utilization below 30%. The pro-level rule? Keep it below 10% for the highest score impact. This is one of the fastest ways to boost your score. Simply paying down your credit card balances can make your score jump in as little as a month. The third ingredient at 15% is the length of your credit history. Age is an asset here. Lenders love to see a long, established track record of responsible borrowing. This factor looks at the average age of all your accounts and the age of your oldest account. A 20-year-old credit card that you've managed well is like a glowing letter of recommendation. This is why the common advice is to never close your oldest credit card, even if you don't use it much. Cutting it up might feel like a good spring cleaning, but you're actually erasing a huge chunk of your positive history and lowering the average age of your accounts, which can cause your score to drop. Just keep that old account open, use it for a small recurring purchase once or twice a year, and pay it off immediately. Coming in at 10% is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are two main categories: revolving credit, like credit cards where your balance and payment can change each month, and installment loans like a car loan or a student loan, where you have a fixed payment for a set period. Having a healthy mix of both shows you're a versatile and experienced borrower. It's not a reason to go out and get a car loan you don't need, but it does mean that responsibly paying off your student loans and using a credit card is building a stronger, more diverse credit profile than just having one or the other. Finally, the last 10% is based on new credit. This refers to how many new accounts you've recently opened and how many times you've applied for credit. Every time you formally apply for a loan or a credit card, it results in a hard inquiry on your report. One or two inquiries here and there isn't a big deal. But if a lender sees you've applied for 5 new credit cards and a personal loan in the last 6 months, it screams desperation. It looks like you're in financial trouble and scrambling for cash. This is critically important in the year leading up to your mortgage application. Avoid opening new lines of credit unless absolutely necessary. Don't go finance a new car or a new set of furniture right before you try to buy a house. Now, there is a smart exception to this rule. When you're rate shopping for a mortgage, the FICO model is intelligent. It understands that you're comparing offers. Any mortgage-related inquiries that occur within a 30 to 45-day window are typically bundled together and treated as a single inquiry, minimizing the impact on your score. So shop around for the best mortgage rate without fear. So now you know the 5 ingredients: payment history, amounts owed, length of history, credit mix, and new credit. But what does this mean in real dollars and cents when you're getting a mortgage? The answer is everything. Let's run a quick, jaw-dropping example. Imagine you're buying a home and need a $400,000 mortgage. If you have an excellent credit score, say 760 or higher, you might qualify for an interest rate of 6.5%. Your monthly principal and interest payment would be about $2,528. Now, let's say your credit score is just okay, maybe 670. You're still approved, but the lender sees you as a slightly higher risk. So they offer you a rate of 7.5%. That 1 percentage point difference might not sound like much, but your new monthly payment is $2,796. That's an extra $268 every single month. Over the course of a 30-year loan, that 1 percentage point dictated by your credit score will cost you an extra $101,000. Read that again. Over $100,000 in extra interest, all because of that 3-digit number. A great credit score isn't just a nice to have. It is a money-making machine that saves you a fortune. It determines your interest rate, can lower your private mortgage insurance premiums, and is often the deciding factor between getting approved or getting denied. So how do you take action? First, you need to know where you stand. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once a year. Go to annualcreditreport.com, the official government-mandated site, to get them. Don't be fooled by lookalike sites. When you get your reports, go through them with a fine-tooth comb. Look for errors. Is there an account listed that isn't yours? A late payment reported on a bill you know you paid on time? Mistakes happen, and you have the right to dispute them. Correcting an error can be a huge, immediate boost to your score. Your credit score is not your destiny. It's not a tattoo. It's a dynamic living number that you have the power to change. By focusing on those 5 key ingredients, paying bills on time, keeping credit card balances low, letting your accounts age, maintaining a healthy mix, and being smart about new credit, you are not just building a score. You are building a financial reputation. You are building trust. And that trust, that proof of your financial responsibility, is step 1. But there's another massive piece of the puzzle that every lender wants to see. It's the single biggest financial hurdle for most first-time homebuyers, and it's surrounded by more myths and misinformation than anything else in the entire process. It's your down payment. And in the next part, we are going to shatter the biggest myth of all, the 20% rule, and show you exactly how you can buy a home with a lot less cash than you ever thought possible. For decades, the idea of a 20% down payment has been hammered into our heads. It's been treated as the golden ticket, the non-negotiable price of admission to the world of homeownership. And for millions of Americans, it's the single biggest barrier that makes the dream feel impossible. Well, I'm here to tell you that the 20% rule is one of the biggest, most persistent, and most damaging myths in all of personal finance. It is not a law. It is not a requirement. It is, for the vast majority of homebuyers in America today, completely and totally optional. So where did this myth even come from? Why does everyone from your parents to your high school economics teacher talk about 20%? The answer comes down to two words: risk and insurance. From a lender's perspective, the person putting down less than 20% on a home is a slightly riskier bet. If that person stops making payments and the bank has to foreclose, the bank wants to be sure it can sell the house and get all of its money back, even if the market has dropped a little. That 20% down payment acts as a huge financial cushion for them. It's 20% of their own money that the borrower would lose first, which makes it far less likely they'll just walk away. But what if you don't have that cushion? That's where something called private mortgage insurance, or PMI, comes in. And this is critical. PMI is not insurance for you. It's insurance that you pay for on behalf of your lender. Protects them in case you default on the loan. So the 20% figure isn't some magic number for homeownership success. It's simply the threshold where lenders feel safe enough that they no longer require you to pay for their insurance policy. That's it. It's a risk calculation for them, not a readiness requirement for you. The real problem is that for the average person, saving 20% is like trying to run a marathon with a moving finish line. Let's do some quick, terrifying math. The median home price in the United States is hovering around $400,000. A 20% down payment on that is $80,000. $80,000 in cash. Now, the median individual income is about $60,000 a year. After taxes, rent, car payments, groceries, and just living, how long would it take you to save 80 grand? For most people, the answer is a decade or longer. And here's the cruelest part of the joke. While you're diligently saving for 10 years, what are home prices doing? They're going up. That $400,000 house might be a $550,000 house by the time you've saved up. And now you need $110,000 for your down payment. The finish line just moved 30 grand further away. It's a cycle that traps people in renting for life, paying their landlord's mortgage instead of their own. But this is where we break the cycle. Because there are powerful government-backed loan programs specifically designed to shatter this 20% barrier. These aren't shady back-alley loans. These are the most common ways people buy homes in America. Let's start with the most popular one for first-time buyers: the FHA loan. FHA stands for the Federal Housing Administration, and their flagship program allows you to buy a home with as little as a 3.5% down payment. On that same $400,000 house, that's not $80,000. It's $14,000. Now, that is still a lot of money, but it is a profoundly, life-changingly different goal than $80,000. FHA loans are also more forgiving on credit scores, making them accessible to a much wider range of people. The trade-off? You'll have to pay FHA's version of mortgage insurance, called MIP, or mortgage insurance premium. It's a bit different from PMI, and a key thing to know is that for most FHA borrowers, that MIP payment lasts for the entire life of the loan, unless you refinance later. But it's the tool that gets you in the door. Next up, we have conventional loans. These are the loans you hear about most often, the ones backed by Fannie Mae and Freddie Mac. And guess what? The 20% myth is just as false here. Programs like the Conventional 97, Home Ready, and Home Possible allow qualified buyers to get a conventional loan with just 3% down. That's right, 3%. On that $400,000 house, your down payment is now just $12,000. These loans typically require a higher credit score than FHA, but they have a massive advantage. With a conventional loan, the private mortgage insurance, the PMI, is not permanent. By law, your lender must automatically terminate your PMI once your loan balance drops to 78% of the original home value. You can even request to have it removed sooner, once you reach 20% equity. This means you only pay that extra insurance for a few years, and then it's gone forever, lowering your monthly payment. Now, for a very important group of Americans, the deal gets even better. If you are a veteran, an active duty service member, or an eligible surviving spouse, there is the VA loan. And this is, without a doubt, the best mortgage product on the planet. The VA loan allows you to buy a home with 0% down, nothing, a $0 down payment. It is a benefit you have earned through your service to this country. There is no monthly mortgage insurance either. Instead, there's a one-time funding fee that can almost always be rolled into the total loan amount, so you still don't need cash for it at closing. For millions of veterans, the VA loan is the key that makes homeownership a reality when it otherwise wouldn't be. And there's one more zero down option we need to talk about: The USDA loan. This program from the U.S. Department of Agriculture is designed to help develop rural and suburban areas. And you might be shocked to find out what the USDA considers rural. Many small towns and suburbs just outside of major city centers qualify. If you meet certain income requirements and the home you want to buy is in an eligible area, you can get a USDA loan with, you guessed it, 0% down. It's another incredible tool that people often overlook because they assume it's only for farmers. It's not. So, you have FHA at 3.5%, conventional at 3%, and VA and USDA at 0%. The 20% myth isn't just broken, it's obliterated. Now, I know what you might be thinking. Okay, but that mortgage insurance, that PMI or MIP, sounds like a penalty. It sounds like I'm being punished for not having $80,000 in a suitcase. I want you to completely reframe how you think about this. Mortgage insurance is not a penalty. It is a tool. It is the key that unlocks the door to homeownership 5, 10, or 15 years sooner than you could otherwise. Think about it this way. Would you rather spend the next 10 years paying $2,000 a month in rent? That's $240,000 you will never see again, while you try to save for a 20% down payment as home prices climb higher and higher. Or would you rather buy a house now with 3% down, pay an extra $150 a month in PMI for a few years, and start building your own equity immediately? For nearly everyone, the math on that is overwhelmingly clear. That $150 a month is the price you pay to start building hundreds of thousands of dollars in your own net worth right now instead of your landlord's. You're trading a small temporary monthly cost for a massive, immediate, and long-term financial gain. It's one of the best trade-offs in all of finance. And remember, on a conventional loan, it's not forever. You can get rid of it. As you make your monthly payments, your loan balance goes down. As the housing market improves, your home's value goes up. Both of these things build your equity. Once you have 20% equity, you can call your lender, get a new appraisal, and request to have the PMI removed. It's a straightforward process. The bottom line is this: the idea that you need to be rich, that you need a massive pile of cash sitting in the bank to buy a home, is a lie. A persistent, destructive lie. You have options. Powerful options. Whether it's 3.5%, 3%, or even 0% down, the path to owning your own home is far more accessible than you've been led to believe. You can do this. The biggest cash hurdle has just been lowered from a skyscraper to a speed bump. But the down payment isn't the only cash you'll need. There's another set of costs, a second financial hurdle that blindsides so many first-time buyers and can completely torpedo a deal just days before closing. They're called closing costs, and they can add up to thousands of dollars you weren't expecting. But what if I told you there are ways to get the seller, or even the lender, to pay for them? In the next part, we will pull back the curtain on every single closing cost, show you exactly what to expect, and reveal the strategies you can use to potentially buy your home with little to no cash out of your pocket at all. So you've found the perfect house. You've negotiated a price. You've been pre-approved for a mortgage. The finish line is in sight. But then a document appears. It's called a loan estimate, and it's covered in a dizzying array of fees and charges you've never heard of. This, my friends, is the final boss of the home buying journey. Closing costs. These are the thousands, sometimes tens of thousands, of dollars you need to bring to the table in addition to your down payment. They are the silent killer of home buying budgets, and the #1 source of sticker shock for first-time buyers. But not for you, because right now we are going to demystify every single line item. We're going to break down this complex puzzle into 3 simple buckets so you know exactly what you're paying for, why you're paying for it, and most importantly, how to potentially reduce it. Let's start with the first bucket: lender fees. Think of this as the bank's compensation for creating and managing your loan. The biggest one you'll see is the origination fee. This is the lender's primary charge for the service of lending you hundreds of thousands of dollars. It covers their operational costs, the loan officer's salaries, the paperwork, keeping the lights on. It's typically calculated as a percentage of the loan amount, usually somewhere between 0.5 and 1%. So on a $400,000 loan, that's $2,000 to $4,000 right there. Next, you might see discount points. This is one of the most misunderstood fees. Discount points are essentially prepaid interest. You are voluntarily paying the bank a fee up front in exchange for a lower interest rate for the entire life of the loan. 1 point typically costs 1% of the loan amount and might lower your rate by 0.25%. Whether this is a good deal depends entirely on how long you plan to stay in the home. If you pay $2,000 for points to save $30 a month, you'd need to stay in the house for almost 6 years just to break even. It's a math problem, and we'll show you exactly how to solve it later on. Finally, in this bucket, you'll find smaller administrative charges like an underwriting fee or a processing fee. Underwriting is the process where the lender's team of financial detectives verifies every single piece of your financial life to make sure you're a good risk. Processing is the administrative work of gathering and organizing all that documentation. These are the fees for the human labor involved in making your loan a reality. Okay, that's the bank's cut. Now for the second and largest bucket, third-party fees. These are fees for services provided by other companies, not your lender, that are absolutely essential to closing the deal. Your lender requires them, but you're the one who pays for them. First up, the appraisal fee. Before a bank gives you a massive loan, they need to be sure the house is actually worth what you're paying for it. So they hire an independent, licensed appraiser to inspect the property, compare it to similar recently sold homes, and determine its official market value. This protects the bank from lending you $400,000 for a house that's only worth $350,000. It also protects you from overpaying. Next is the credit report fee. This one's usually small, maybe $30 to $50, but it's non-negotiable. The lender needs to pull your detailed credit history and scores from all three major bureaus, Equifax, Experian, and TransUnion, to assess your creditworthiness. Now for a big one, title services. This is huge, and it's critically important. When you buy a house, you're not just buying wood and drywall. You're buying the legal right to own it, known as the title. A title company performs a detailed title search, digging through historical records to make sure the person selling you the house actually has the free and clear right to sell it. They're looking for hidden landmines, unpaid property taxes from a previous owner, a contractor's lien, a surprise heir from a will 50 years ago. Once the search is clear, you'll pay for title insurance. This is a one-time premium for an insurance policy that protects you and the lender from any of those hidden landmines surfacing in the future. Think of it as a force field for your ownership rights. You'll see two policies: a lender's title insurance policy, which is mandatory and protects the bank, and an owner's title insurance policy, which is technically optional but something you should almost never, ever skip. Here's a pro tip. In many states, you can shop around for your title company to find better rates. Don't just accept the one your agent or lender suggests without checking. You'll also have a home inspection fee. While the appraisal is for the bank, the inspection is for you. You hire a professional inspector to go through the house with a fine-toothed comb, checking the foundation, the roof, the plumbing, the electrical system, everything. Their report can reveal costly issues that you can then use to renegotiate the price or even back out of the deal. Never skip the inspection. Depending on the property, you might also have a survey fee, where a surveyor comes out to officially map the property lines, and government recording charges, which are the fees your local county clerk charges to legally record the sale and make you the official new owner in the public record. That's a lot, I know, but we're almost there. The third and final bucket is a little different. It's not really a fee for a service, but it's still cash you need at closing. This bucket is for prepaids and escrows. Essentially, you are prepaying some of your own future housing expenses. First, you'll prepay a full year's premium for your homeowner's insurance. Your lender requires this to be paid up front at closing to ensure their investment, your house, is protected from day one. Second, you'll prepay a few months' worth of property taxes. The exact amount depends on when you close and how your local municipality collects taxes, but the lender will collect this money from you at closing and put it into a special savings account. Which brings us to the escrow account. Think of your escrow account as a forced savings account managed by your lender. Every month, a portion of your mortgage payment will be diverted into this account. Then, when your property tax and homeowner's insurance bills are due each year, the lender pays them for you automatically from the funds in this account. At closing, you have to pre-fund this account with a small cushion, usually a couple of months' worth of tax and insurance payments, to make sure there's always enough money in there to cover the bills. It's your money for your bills, you're just paying it into a managed account ahead of time. Finally, there's prepaid interest. Your first mortgage payment isn't usually due until the first day of the month after the month you close. So if you close on May 15th, your first payment isn't until July 1st. That payment will cover the interest for the month of June. But what about the interest from May 15th to May 31st? You pay for that at closing. It's called prepaid daily interest. A little trick here is to try and close at the end of the month. If you close on May 29th, you only have to pay for 2 days of interest, versus the 16 days you'd pay for if you closed on the 15th. So let's recap. You have lender fees, third-party fees, and prepaids. Altogether, these closing costs typically add up to between 2 and 5% of the home's purchase price. On that $400,000 house, that's another $8,000 to $20,000 you need in cash on top of your down payment. It's a massive, daunting number. It's the final hurdle that trips up so many aspiring homeowners. But remember the promise we made? To reveal the strategies you can use to potentially buy your home with little to no cash out of your pocket? This is where the magic happens. Because there are two powerful tools you can use to combat these costs: seller concessions and lender credits. These are the secret weapons that can dramatically reduce, or in some cases, completely eliminate the need for you to bring this extra cash to the closing table. They are your key to turning that mountain of fees into a manageable molehill. So let's break down these two power moves, starting with the one that involves the other key player in this transaction: the seller. This is called a seller concession or seller credit. Imagine you're in a negotiation. You found the perfect house, listed for $400,000. Your closing costs, after doing all the math, are estimated to be around $12,000. That's a lot of cash to bring to the table on top of your down payment. Here's the move. Instead of offering the seller $400,000, you offer them $412,000, with one critical condition. You ask them to use that extra $12,000 to pay for your closing costs on your behalf. Think about what just happened. From the seller's perspective, they're getting their asking price. Whether they get a check for $400,000 or a check for $412,000 and immediately pay $12,000 in your costs, their net profit is exactly the same. They walk away with the same amount of money. So why would they do it? Because it makes the deal happen. It gets a qualified, eager buyer into their home, and it costs them nothing. For you, the buyer, this is a game changer. You haven't eliminated the closing costs. That's a common misconception. You've simply rolled them into your loan. Your loan amount is now $12,000 higher, which will slightly increase your monthly payment over the next 30 years. But the monumental benefit is that you didn't have to drain your savings account of an extra $12,000 just to get the keys. You've converted a massive upfront cash problem into a tiny, manageable monthly problem. Now, this isn't a free-for-all. You can't just ask for $50,000 in concessions on a $200,000 house. There are rules. Lenders and loan programs cap the amount a seller can contribute, and these caps depend on the type of loan you have and the size of your down payment. For an FHA loan, for example, the seller can contribute up to 6% of the home's purchase price. For a conventional loan, the limits vary. If you're putting down less than 10%, the seller can typically contribute up to 3%. If your down payment is between 10 and 25%, that cap often rises to 6%. And if you're putting down more than 25%, you can sometimes get up to 9% in concessions. But there is one giant critical hurdle you have to clear for this strategy to work: the appraisal. Remember the appraiser? The independent third party who determines the home's fair market value? The house must appraise for your higher offer price. In our example, the house has to be officially valued at $412,000 or more. If the appraiser comes back and says the house is only worth $400,000, the bank will only lend you money based on that lower value. The entire deal could fall apart. The seller won't get their extra $12,000 to give back to you, and you're back to square one. This is why seller concessions are most common in a balanced or a buyer's market, where home values are stable and sellers are more motivated to make a deal work. In a red-hot seller's market, where multiple buyers are bidding over the asking price, asking for concessions can make your offer look weak and get it tossed in the trash. So what happens then? What if the seller says no? What if the market is too competitive? You have another weapon in your arsenal, and this one doesn't involve the seller at all. It's a deal you make directly with your lender. It's called a lender credit. This is the classic pay me now or pay me later scenario. With a lender credit, the lender agrees to pay for some, or even all, of your closing costs. Sounds like a gift, but it's not. Nothing in finance is ever truly free. In exchange for the lender giving you this credit, you agree to accept a slightly higher interest rate on your loan for its entire term. Let's run the numbers because this is where the decision gets real. Suppose you're offered a loan with a 6% interest rate and you have to pay $10,000 in closing costs out of pocket. That's option A. But the lender says they have another option for you, option B. They'll give you a $10,000 lender credit to cover all of your closing costs, meaning you bring $0 for fees to closing. The catch? Your new interest rate will be 6.5%. You've just traded a one-time $10,000 cash payment for a higher interest rate that will stick with you for years. On a $400,000 loan, that 0.5% difference in interest rate might mean your monthly payment is about $150 higher. $150 a month might not sound like much, but over 30 years, that adds up to $54,000 in extra interest payments. You saved $10,000 up front, but it cost you an extra $54,000 over the long haul. So, is this a terrible deal? Not necessarily. It all depends on your timeline and your financial situation. When does a lender credit make sense? It's a brilliant move if you're cash poor but payment rich. Maybe you have a great income and can easily afford the slightly higher monthly payment, but you just don't have the liquid cash saved up for a down payment and $10,000 in closing costs. This gets you into the house. It's also a smart strategic move if you don't plan on being in the home for very long. If you know you're likely to move or sell in, say, 5 years, you won't be paying that higher interest rate for the full 30-year term. You can calculate your break-even point. In our example, if you're saving $10,000 up front but paying an extra $150 a month, you divide $10,000 by 150. The answer is about 67 months or just over 5.5 years. If you sell the house before that break-even point, you came out ahead. You saved more on the upfront cost than you paid in extra interest. But if you stay in the house longer than that, the lender starts winning the deal, and every month you stay, they win by a little bit more. It can also make sense if you believe interest rates will drop significantly in the near future, and you plan to refinance into a lower rate loan anyway. You take the credit and the higher rate now just to close the deal, knowing you'll be getting out of that loan in a year or two. The choice between asking for seller concessions or taking a lender credit is deeply personal. One isn't inherently better than the other. They are simply different tools for different situations. A seller concession is about negotiation and market conditions, financing your costs into the loan principal. A lender credit is a direct trade-off with your bank, exchanging a higher long-term cost for immediate upfront relief. Understanding how both of these work gives you flexibility, gives you options. It allows you to tailor your home buying strategy to your exact financial reality, not just the one-size-fits-all model. So you've navigated the fees, you've chosen your weapon to conquer the mountain of closing costs, and you've gotten the green light from your lender. You can see the finish line. All the paperwork, the searching, the stress, it's all led to one final monumental event, the closing day. But what actually happens in that room? Surrounded by stacks of paper, what are the last-minute landmines and legal documents that stand between you and the keys to your new life? Let's pull back the curtain on this final ceremony of home buying. Closing day isn't just a meeting. It's a legal transaction, a transfer of ownership, and the moment a mountain of conditional promises becomes a concrete reality. Think of it as the grand finale of a long, complicated play where you are the star. But before you even sit down at that closing table, there's one critical mission you must undertake: the final walkthrough. This is not a casual stroll. This is your last chance to inspect the property before it legally becomes your responsibility. The sellers have moved out, the furniture is gone, and the home is now a blank canvas. Your job is to ensure that the condition of the house is exactly what you agreed to in the purchase contract. You're checking for two main things. First, that any contractually obligated repairs have been completed properly. If the seller agreed to fix that leaky faucet or patch the drywall, you need to verify it's done to a reasonable standard. Bring your inspection report and your repair agreement with you. Second, you're making sure no new damage occurred during the move-out process. Look for new dings in the walls, deep scratches on the hardwood floors, or broken fixtures. Test the appliances one last time. Run the faucets, flush the toilets, flip the light switches. Confirm that everything the contract said would be left behind, like the refrigerator or the window treatments, is still there. What happens if you find a problem? This is a critical moment. You don't panic, but you also don't ignore it. You immediately call your real estate agent. Depending on the severity of the issue, a few things can happen. For a minor problem, the sellers might agree to give you a credit at closing to cover the cost of the repair. For a major issue like a burst pipe, the closing might need to be delayed until it's resolved. This is why the final walkthrough is your ultimate safety net. It's the last checkpoint before you sign your rights away and accept the property as is. Assuming the walkthrough goes smoothly, you'll head to the closing location. This is typically the office of a title company, an escrow company, or an attorney. When you walk in, you'll see a cast of characters around a table. There's you, the buyer. Sometimes the seller is there, though in many cases they pre-sign their documents. You'll have your real estate agent for moral support and guidance. And running the show is the closing agent, a neutral third party, often an attorney or a title officer, whose job is to ensure the transaction is executed correctly, the money is distributed, and the title is properly transferred. A representative from your lender might also be present, but often they work behind the scenes. Now comes the main event, the paper. You'll be faced with a stack of documents that can be an inch thick. It's intimidating, but you don't need to read every single word of every single document right there. That's what the review period beforehand was for. However, you absolutely need to understand what you're signing. Let's focus on the 3 heavyweight champions of the closing table. First, the most important document for you to review is the closing disclosure or CD. You should have already received a preliminary version of this at least 3 business days before closing. This is federal law designed to give you time to review it without pressure. The CD is the final itemized breakdown of your entire loan and all the costs associated with it. It's the financial report card for the biggest purchase of your life. Your mission here is to compare this final CD with the loan estimate you received at the very beginning of the process. Are the numbers the same? Specifically, check the loan amount, the interest rate, the monthly payment, and the cash to close amount. The cash to close is the exact figure you need to bring to the table. Most of the fees should be very close to what was estimated. Some, like the lender's origination fee, cannot change at all. Others, like title insurance, can change within a certain tolerance. If you see a major discrepancy, you stop everything and ask the closing agent to explain it. Do not sign until you understand every line item. This is your money. Once you're satisfied with the closing disclosure, you'll meet the second heavyweight, the promissory note. This one is simple, direct, and incredibly powerful. The promissory note is your IOU to the lender. It is your personal, legally binding promise to repay the loan according to the specified terms. It details the total amount you borrowed, the interest rate, the dates when payments are due, and where they should be sent. It also outlines the penalties for late payments and what happens if you default on the loan. When you sign this document, you are personally guaranteeing the debt. This isn't a promise tied to the house. It's a promise tied to you. It's the core of your financial obligation. The third and final champion is the mortgage, or in some states, the deed of trust. While the promissory note is your promise to pay, the mortgage is the security for that promise. This is the document that officially ties your loan to your new property. It gives the lender a legal claim against your house if you fail to uphold the terms of the promissory note. In essence, it says, if I don't pay my loan, the lender has the right to force the sale of this property to get their money back. This process is called foreclosure. The mortgage or deed of trust is what makes your home the collateral for the loan. It gets recorded in the county land records, creating a public notice of the lender's lien on your property. It's the legal instrument that makes the whole system work. You'll sign other documents, of course. The deed, which is the legal document that officially transfers the title from the seller to you. You'll sign tax forms, affidavits confirming your identity and marital status, and disclosures about everything from flood zones to lead paint. Your hand will hurt. You'll probably go on autopilot for some of it. But never lose focus on those big 3. The closing disclosure, the promissory note, and the mortgage. While you're signing, the money is also moving. You won't be bringing a personal check or a briefcase of cash. You'll need to provide a certified or cashier's check for the cash to close amount shown on your closing disclosure, or more commonly, you'll have arranged a wire transfer ahead of time. This amount covers your down payment plus all of your closing costs, things like lender fees, appraisal fees, title insurance, attorney fees, and prepaid property taxes and homeowners insurance. The closing agent acts as the central hub, collecting your funds and the lender's funds, and then dispersing them to the seller, the real estate agents, the tax authority, and everyone else who needs to be paid. Once every page is signed and every penny is accounted for, there's a moment of quiet anticipation. The closing agent will often make a few calls to confirm that the lender has released the funds and that the county has accepted the deed for recording. And then it happens. The closing agent or the seller's agent slides a set of keys across the table. They're yours. In that single moment, the months of searching, the stress of applications, the anxiety of negotiations, it all melts away. You are no longer a future homeowner. You are a homeowner. You've conquered the process, navigated the paperwork, and earned the keys to your front door. But as you stand on your new doorstep, a new reality begins to set in. The mortgage is no longer a theoretical concept. It's a monthly payment. The house is no longer a listing on a website. It's a living, breathing thing that requires care, maintenance, and money. What are the hidden costs and responsibilities that nobody talks about? What does the first year of homeownership really look like? And how do you avoid the most common and costly rookie mistakes? Let's pull back the curtain on that first year, because it's where the abstract numbers on your mortgage documents become intensely real. The biggest shock for most new homeowners isn't the mortgage payment itself. You've planned for that. It's the constant, relentless trickle of other expenses that your lender never mentioned and your apartment-dwelling brain never had to consider. First up, the immediate hit, moving and initial setup. This isn't a hidden cost, but people chronically underestimate it. It's not just the moving truck. It's the new lawnmower you need because your new yard isn't a balcony. It's the window treatments, because you suddenly realize your neighbors have a direct view into your living room. It's the frantic trip to Home Depot for a new shower curtain, a longer hose, and that one weird type of light bulb you've never seen before. This initial wave can easily cost thousands of dollars you didn't budget for, right after you've drained your savings for the down payment. Then comes the first utility bill. In an apartment, you might have paid for electricity. Now, you're paying for electricity to power a much larger space. You're paying for gas or oil to heat it. You're paying for water not just for your showers but for the lawn you now have to keep alive. You're paying for trash and recycling pickup. These bills combined can be hundreds of dollars more per month than you were used to, a second smaller mortgage payment hiding in plain sight. But the true silent killer of budgets is maintenance and repairs. Your home inspector gave you a list of things that were nearing the end of their functional life. In the excitement of closing, that sounds like a future problem. In reality, end of functional life means it's going to break on the coldest night of the year, or during the biggest rainstorm of the season. The day your water heater decides to retire is the day you learn that a new, installed unit costs over $1,000. The moment your air conditioner gives up in the middle of a July heat wave, you're not just paying for a new unit, you're paying an emergency call-out fee to the technician who can get there the fastest. This is the fundamental shift. You are now the landlord. Every clogged drain, every flickering light, every leaky faucet is your problem and your expense. There's no one to call to fix it for free. This is why the most critical piece of advice for any new homeowner is to have a dedicated home maintenance fund, separate from your personal emergency fund. Most experts recommend setting aside 1% to 3% of your home's purchase price every single year for these costs. So on a $400,000 house, that's $4,000 to $12,000 a year, or about $330 to $1,000 a month, that you need to be saving just for the house itself. Sounds like a lot, and it is. But when your roof starts leaking, a $10,000 repair bill is a lot more. And let's talk about the two big, recurring costs that are baked into your mortgage payment, but can still surprise you: property taxes and homeowners insurance. You pay them monthly into an escrow account, and the lender pays the bill for you once a year. Feels automatic, seamless, until it's not. The problem is these costs aren't fixed. When the city reassesses your home's value, which they will, your property taxes will go up. When insurance companies face more claims in your area due to storms or fires, your insurance premiums will go up. And when that happens, your lender will do something called an escrow analysis. They'll find out they didn't collect enough money from you last year to cover the new, higher bills. So now you have an escrow shortage. This means your monthly mortgage payment is going to increase. Not because of your loan, but to cover the higher taxes and insurance, and to pay back the shortage from the previous year. This is the payment shock that hits so many people in their second or third year of ownership. They thought they had a fixed payment, but it suddenly jumps by $100, $200, or even $300 a month. It's a brutal lesson in the ever-changing cost of homeownership. To avoid this rookie mistake, you need to be proactive. Pay attention to your local property tax assessments. Shop around for homeowners insurance every couple of years to make sure you're getting a competitive rate. And mentally prepare for your payment to creep up over time. Don't get so comfortable with the initial number that a small increase throws your entire budget into chaos. Another common mistake is falling into the renovation trap. You watch all these home improvement shows, you scroll through Pinterest, and you suddenly feel an overwhelming urge to tear down a wall or gut your 1980s-era bathroom. You just made the biggest purchase of your life, and your first instinct is to spend another $50,000. This is a massive error. The best advice is to live in your house for at least one full year before you undertake any major renovations. Why? Because you don't know the house yet. You don't know how the light hits the kitchen in the morning. You don't know which parts of the house are drafty in the winter. You don't know how your family actually uses the space. After a year, you'll have a much clearer, more practical vision of what you actually need, versus what you thought you wanted. That year of waiting can save you from making a trendy but impractical decision that costs a fortune to undo. Instead, focus on small, high-impact, low-cost projects in that first year. A fresh coat of paint can transform a room for a few $100s. Changing out old light fixtures or cabinet hardware can update a space for a weekend's worth of work. These small victories will make the house feel like yours without draining your brand new home maintenance fund. So, what have we learned through this entire journey? We've learned that a mortgage isn't just a loan. It's a multi-decade financial commitment that acts as the key to a different kind of life. We've demystified the jargon: principal, interest, escrow, amortization, turning confusing terms into understandable concepts. You now know the difference between a conventional loan and an FHA loan, the power of a good credit score, and the critical importance of a down payment. You understand that the interest rate you get is a direct reflection of the risk you represent to a lender, and that you have the power to improve that rate. You know that PITI, principal, interest, taxes, and insurance, is the true monthly cost you need to budget for, and that it's not always as fixed as you might think. We've walked through the pre-approval process, the gauntlet of underwriting, and the final paper-filled ceremony of closing. But most importantly, we've looked beyond the paperwork. We've seen that a mortgage is the financial tool, but the home is the actual goal. And that home is not a static asset. It's a living, breathing entity that requires your time, your attention, and your money. It will break, it will need care, and it will surprise you with unexpected costs. The journey to homeownership is not about finding the perfect house. It's about finding a house you can afford to live in, maintain, and grow with over time. It's about understanding the total financial picture, not just the monthly payment. It's about building a budget that can withstand the shock of a broken furnace and still allow you to live your life. This process can feel overwhelming. It's designed to be complex, but you are now armed with the knowledge to navigate it. You can walk into a lender's office with confidence. You can analyze a loan estimate with a critical eye, and you can anticipate the challenges of that first year instead of being blindsided by them. The American dream of homeownership is still very much alive, but it looks different now. It requires more knowledge, more planning, and more financial discipline than ever before. It's not just a white picket fence. It's a 30-year amortization schedule, a healthy emergency fund, and a deep understanding of what you are signing up for. Your home will likely be the biggest and best investment you ever make. Not just financially through the building of equity, but emotionally. It's the backdrop for your life's most important moments. It's a source of stability, pride, and community. The mortgage is simply the price of admission to that experience. And now, you know exactly what that price entails. You are ready. Go build your future.